Look, I'm not here to tell you my life story. I'm 18 years old and I made over $20 million trading crypto, and in this video, I'm going to be giving you 7 years of knowledge condensed into the most valuable crypto education you'll get for free. And this isn't just going to be some motivational speech, this is going to be tactical information that took me years and millions of dollars to learn. And today, we're going to be covering market cycles and why most people are playing a rigged game, why emotions destroy portfolios faster than any crash, risk management that actually works, and why Bitcoin is the only foundation worth building, and the altcoin strategy that generates real alpha. I'm going to also teach you how to generate profits without fumbling generational wealth and the psychology hacks that separate winners from losers. And if you make it until the end, you'll understand more about wealth creation in crypto than 99% of traders. So let's get started, guys. Alright, so the first thing you need to understand is that market cycles are everything, and most traders completely misunderstand them. Here's a pattern I see on repeat. New traders join during bull runs, they see green candles every single place, and their friends are making money. It's all over Twitter, so they buy. And they only know one direction, and that's up. They see a green candle and they buy more. And that's their entire strategy. And then 6 months later, they're holding bags, down 80%, wondering what happened. They're posting in crypto, when moon, should I hold? And bro, you literally missed the entire cycle. Bitcoin has historically followed 4-year cycles, and they're pretty much predictable if you're paying attention. But here's what's changing. This cycle is structurally different from previous ones. A lot of people, especially the ones that have been in crypto for one cycle, think that we're near to the top. They're calling for crashes, and they think that the 4-year pattern is some universal law. And that's just some outdated thinking. The 4-year cycle has made sense when crypto was just retail speculators gambling on weekends. But now, we have BlackRock buying billions of dollars of Bitcoin, Fidelity launching EFTs, countries adding Bitcoin to strategic reserves, and we're seeing institutional flows that dwarf retail. Some days, billions of dollars flowing into Bitcoin ETFs within a single session. And this isn't speculation anymore. This is capital allocation away from devaluating fiat currencies. So if you look at the bigger picture, Trump's in office. Fiscal stimulus is flowing, money supply is expanding, and real interest rates are suppressed. The US national debt is over $36 trillion and climbing, and they're printing money. Inflation is high even though they manipulate the numbers. So where does that capital flow? Risk assets, Bitcoin, crypto. Gold just hit all-time highs, guys, and Bitcoin is next in line. And here's what most people miss. Bitcoin isn't competing with Ethereum or Solana or meme coins. Bitcoin is competing with gold. Gold is a 20 trillion plus asset class, and Bitcoin is around 2 trillion. If Bitcoin takes 10% of gold's market share, that's 10x from here, and that puts Bitcoin over $1 million per coin. Is that happening tomorrow? No, but over the next decade, absolutely possible. So the simple framework that I use is higher highs plus higher lows equals bull market, and lower highs plus lower lows equals bear market. That's it. You don't need complicated indicators. Or you can use the 50-week moving average. Price trading above it, that's bullish structure. Price trading below it, that's bearish structure. And right now, Bitcoin is in a clear uptrend. We're making higher highs and the structure is bullish. Bull markets always end the same way, retail euphoria. So that happens when your barber asks about crypto, your Uber driver mentions Dogecoin, or your mom also wants to buy some random altcoin she saw on TikTok. That's the top. We haven't seen that yet, not even close. Most people I know in real life have heard of crypto, but they don't own any. They don't understand it, and they think that they've missed it. But when those people start buying, that's when you start selling. Respect market structure over narratives. Don't fall in love with your positions, and your job is to identify which phase we're in and position accordingly. Right now, I would say we're still in expansion, but you need to be ready when that shifts. And let me just talk to you directly for a second. If you're watching this and you feel like you've missed the boat, or if you've been stuck holding bags, or you've just lost, I want you to know that every single cycle, there's a reset. Every single cycle, there is a new chance to get it right. You don't need to be early, you need to be prepared. You don't need to be perfect, you need to be adaptable. And the market doesn't care about your past mistakes, it cares about your next decision. So wipe that slate clean. Forgive yourself for the dumb trades, the FOMO buys, the missed tops, and think of it as a reset. You want to start fresh and you want to start smart. So I'm going to teach you exactly what you need to be doing. The market doesn't take your money. Your emotions give it away. So let me just say that again. Your behavior, not the market, is what destroys your portfolio. Social media weaponizes FOMO, and you see someone post a massive win and instantly you feel behind. You see a coin pump 50% in an hour and your brain screams, I'm missing out. So you ape in at the top and you become exit liquidity for people who bought in earlier. FOMO is real, I understand that, and it's the fastest way to blow up your account. Another killer pattern that I always see is you take a loss and you're down 20% and you feel like you need to make it back immediately, so you force a shitty trade just to break even. You oversize and you ignore your rules, and that's how you make it worse. That's called tilt, and that's also called revenge trading. And I've seen it destroy traders more than any market crash. And I know that sounds super boring, but it changed everything for me. Just journaling every single trade, after every single session, you want to write down what was the narrative, why did I enter, and why did I exit or hold, and what would I do differently. You want to track your emotional state. Was I feeling FOMO? Was I tilted from a previous loss? Or was I overconfident from a win? Or did I follow my system, or did I improvise? If you track that, you can identify patterns, and if you can identify patterns, you can fix them. And before I enter any position, I have 3 things locked in. Entry thesis, why am I buying here? Exit thesis, why am I taking profit or cutting these losses? You also want to have an invalidation point. What would prove me wrong? And if I can't answer all 3 of these things clearly, I don't have a trade. I have a gamble. And I don't gamble. I see this constantly. People buy a coin, they join the Discord, and they change the profile picture to the project logo. They add hashtags to their Twitter bio. And they start defending the project online more aggressively than the actual founder. And I just want to tell you, bro, you're not a community member. You're just emotionally compromised. You're exit liquidity for early investors who understand capital allocation. If you look at the top altcoins from last cycle, Cardano, it's down massively against Bitcoin. Chainlink, it's underperformed Bitcoin for years. And even ETH struggled against Bitcoin until recently. And people who hold those coins thinking that they were early got crushed. You were still coping and convincing each other that it was going to go back. You need to benchmark your performance against Bitcoin, not just USD. If your altcoins aren't outperforming Bitcoin, you're losing. That's as simple as that. So I just want you guys to allocate your capital pretty smartly and just not be a cult member. I also want you guys to rotate into those winners and cut losers. I know it sucks, but don't get emotional about it. That's what I realized after years of trading. I learned that trading isn't 90% technical and 10% psychology. It's literally 10% technical and 90% psychology. And your strategy matters, but if your head isn't right, you're just going to sabotage yourself before the market even gets a chance to. And here's something that most people don't talk about. Your lifestyle affects your trading. And if you're not disciplined off the charts, you're not going to be disciplined on the charts. And if you can't wake up on time, stick to a gym routine, and can't eat consistently, why can you suddenly just become disciplined when money is on the line? You won't. So if you want to fix your trading, you want to fix your life. So wake up at a good time where the market is hot, have a morning routine, exercise, eat well, journal, build discipline in small areas, and it'll transfer to your trading. Emotions kill the most portfolios, and if you can master them and manage them, you're going to be pretty successful in trading. And guys, if you want to change your life, give yourself 1 year. 1 year of going all in, 1 year of discipline, and 1 year of saying no to distractions, no to comfort, and no to the easy path. You'd be genuinely shocked of what you can accomplish in 12 months of relentless focus. Most people never even try. They dabble, they half-ass, and they quit when it gets hard. But if you lock in, if you give trading, investing, or any skill your full energy for just 1 year, you will not recognize yourself on the other side. You don't need to be a genius. You just need to be obsessed. You don't need to be perfect. You just need to be consistent. And truly, guys, it just takes 1 year. That's all it takes to change everything. Next, I'm going to talk about risk management, and the best way to make money in crypto is to not lose it. Seriously, the number 1 rule is survival. Bitcoin is the best performing asset over the last decade, and if you just held Bitcoin and it didn't blow up, you'd outperform 90% of traders. So how do you survive? It's risk management, and most traders have zero understanding of risk management. They oversize positions, they don't use stop losses, and they let one bad trade nuke their entire account. I've seen people turn 10K into 100K and lose it all in 1 week because they got cocky and over leveraged. Guys, I mainly trade meme coins, and I'm very deep into that space, and if you know anything about the Trump coin, you would know that thousands of people retired off of that coin. They made $10 million P&Ls, $1 million P&Ls, but on the contrary, I know those people, those same people who made millions, they round-tripped it all because they got cocky and over-leveraged. I mean, that even happened to me when I was 14 years old. I made $11 million with NFTs, and I got cocky, I was euphoric, I thought I could do anything and turn that $10 million into $100 million, so I full-ported this NFT called Other Side, and then I got fucked. So you guys should have a baseline. Never risk more than 1 to 2% of your portfolio per trade. If you have a 10K account, you could risk 1 to 2%, and that's like $100 or $200 max loss. And if you lose 10 trades in a row, which is statistically unlikely if you have a good system, you're down 10 to 20%. You can recover from that. But if you go all in and lose, you're done. So define your stop loss before entering. Not after the trade moves against you. Before you click buy, you need to know if I'm wrong, when am I getting out, and if you can't answer that, you don't have a trade, you're gambling. Calculate your risk to reward ratios, and if your risk to reward isn't at least 1 to 2, then don't take the trade. Because even if I'm right 33% of the time, I break even with a 1 to 2 ratio. And with a decent strategy, you should be winning more than 33% of the time. Most people think that position sizing is boring. It's really not. It's really the difference between surviving and blowing up. So let's say you find a coin that you're really convicted on. You think that it's going to 10x. Most beginners would throw 50% of their port on it, or worse, 100%. And that's idiotic, because what if you're wrong? What if the dev rugs? Or what if the narrative shifts? What if macro changes? You're cooked. And instead, smart position sizing looks like 10% to 15% of your portfolio on a high conviction trade, 5 to 7% of your portfolio on a medium conviction, and 1 to 3% of your portfolio on a low conviction trade. I would probably keep 75% of my portfolio in a cold storage because that's where I hold my long-term Bitcoin holdings and altcoins. And maybe 20% of your portfolio should be active trading capital for short-term trades, altcoin rotations, and higher conviction trades. That really small percent of your portfolio should be really in those gamble plays. If it goes to zero, I don't care. By separating my capital this way, I physically prevent myself from making those emotional mistakes. I can't blow up my entire portfolio on one dumb trade because I literally don't have access to most of my capital in that trading wallet. Another rule I follow religiously is every single time my active trading wallet exceeds a certain threshold, for example 100 SOL, I sweep that excess into a cold storage. This does two things for me. It forces me to take profits consistently and it limits my risk exposure. If I let profits sit in my trading wallet, I'll eventually do something stupid with them. I guarantee it. But if I move them into a cold storage immediately, they're safe. And risk management isn't just about numbers, it's psychological, right? When you know your max loss before entering a trade, you stay calm. You don't panic when the market moves against you. Most traders lose money because they panic. They see red and they freak out and they close at the worst possible time. And when you predefine your risk, you eliminate that panic response. Risk management isn't all about numbers, it's psychological. When you know your max loss before entering a trade, you stay calm. You don't panic when the market moves against you. And most traders lose money because they panic. They see red, they freak out, and they close at the worst possible time. If you predefine your risk, you eliminate that panic response. I know risk management is boring, it's not sexy, and you're not going to post about it on Twitter and get a lot of likes, but it's the difference between surviving long enough to compound wealth versus blowing up and quitting. So it's truly really important to just master risk management. And let me just be brutally honest with you, most people watching this will never make it, not because they're not smart enough, not because they don't have the right information, but it's because they can't get out of their own way. They let ego, impatience, and emotion run the show. And if you want to win, you need to be comfortable with being uncomfortable. You need to be willing to look stupid, to be wrong, to lose, and to be humbled by the market over and over again. But if you can take the hits, if you can keep showing up, and if you keep learning and adapting, you'll win. Not because you were special, but because you refuse to quit. And the next thing I'm going to be talking about is Bitcoin being the foundation. If your crypto portfolio isn't built off of Bitcoin, you're structurally unsound. And I want to explain. Bitcoin has outperformed every single asset class over the past decade, from $3,000 to $60,000 in 4 years. That's over 1,900%. You didn't need to find the next 100x altcoin, you just needed to hold Bitcoin and not blow up. Every single person wants to skip Bitcoin. They think it's too boring, too expensive, and they think it's already pumped. And they want to find the next Bitcoin, but here's the reality. There is no next Bitcoin. Bitcoin is the only truly decentralized, censorship-resistant, hard-cap digital asset. Altcoins, they're venture bets, centralized to varying degrees. They're controlled by teams and inflationary in most cases. Some will succeed, but most will fail. But Bitcoin has fixed supply, it has 21 million coins ever, and no one can print more. It has decentralization, it has no CEO, no company, and no single point of failure. It has security, it's the most secure blockchain on earth, and the liquidity is 24/7. Altcoins can't claim all of those. Ethereum has inflationary supply, Vitalik has influence, Solana went down multiple times, it's even more centralized, and other altcoins are even worse. So the way I structure my portfolio is 75% Bitcoin because that's my foundation, that's my long-term wealth engine, and I'm not selling this for years. And the next 25% is altcoins, that's for the asymmetric upside, and I rotate this capital based off of market cycles. You might be asking me, James, why do you have 75% Bitcoin? It's because if Bitcoin isn't going up, altcoins are getting destroyed. Bitcoin is the market leader, and when Bitcoin pumps, altcoins follow, and when Bitcoin dumps, altcoins dump harder. You need that stable foundation. Gold is a 20+ trillion asset class. It's the traditional store of value. And Bitcoin is around 2 trillion right now. As more people understand that Bitcoin is superior to gold, it's harder to confiscate, it's easier to transfer, and more scarce, capital will flow from gold to Bitcoin. And if Bitcoin just takes 10% of gold's market cap, that's 10x from current levels. That puts Bitcoin at $1 million per coin, and that's not going to happen next month, but it might happen over the next decade. It's very possible. So I'm accumulating Bitcoin regardless of short-term price. I don't try to time bottoms, I don't wait for the perfect entry. I DCA, I dollar cost average, I buy consistently, I build my stack. Why? Because I know where it's going long term, and I'd rather be positioned than sitting on the sidelines waiting for a dip that might never come. I move it to my cold storage immediately, a hardware wallet, offline, not on an exchange, so that if anything happens, I still have my money. I don't touch it, I don't trade it, I just accumulate. I know Bitcoin is boring, but those boring wins are long term. So I want you guys to understand that you don't have to always chase those shiny new altcoins before you've built a strong foundation off of Bitcoin. So let's talk about the fun part, altcoins. But I just want to be clear that 98% of altcoins will fail. Most won't survive until the next cycle. And if you're holding altcoins that are underperforming Bitcoin, you're going to lose. I allocate 25% of my port to altcoins. That's it. Not 50%, not 70%, 25% max. My reasoning for that is because altcoins are high risk, high reward, but I contain that risk. So here's how I think about altcoins. They're tools to accumulate more Bitcoin. I buy altcoins during accumulation phases. I ride them during expansion. I take profits systematically, and then I just rotate it back into Bitcoin. Altcoins are not long-term holds. With very few exceptions, they're tactical positions, and right now I'm focused on layer 1 blockchains. Why? Because layer 1s are infrastructure. They're the foundation of Web3. Every single thing gets built on top of them. DeFi, NFTs, if you remember them, gaming, all of it runs on layer 1s. And if you invest in a layer 1, you're essentially investing in the app store of that ecosystem. So for example, you might have heard of Ethereum, Solana, Avalanche, etc. And layer 1s have real use cases. Apps actually get built off of them. They have revenue models. Transaction fees generate value. They have network effects. The more apps built on them, the more valuable they become. And they also have venture backing. Institutional capital flows into layer 1s. And if you compare that to a random meme coin with no utility, no revenue, and no institutional backing, which one would you rather hold? A lot of you guys over diversify. You guys buy 40 different altcoins, $100 in that one, $200 in another, and $50 in another. And that's not a strategy. That's just you coping. You can't possibly research 40 different projects deeply enough to have real conviction. I picked 5 to 8 altcoins maximum. I researched them deeply. I understand what's the problem they're solving, who's behind the project, and what's their competitive advantage. What is their total addressable market, and what catalysts are coming. Then, only then, I go in with size, real capital, like 20K, 50K per position, depending on portfolio size. And that 50K position turns into 150K, 300K, 500K if the thesis actually plays out. And that's how you actually generate alpha plays. I only buy altcoins that I believe will outperform Bitcoin in my holding period. If I don't think it's going to outperform Bitcoin, then what's the point? I should just hold Bitcoin then, right? So every single altcoin I buy, I ask myself, will this outperform Bitcoin over the next 6 to 12 months? If the answer isn't a strong yes, then I will pass. And within altcoins, I will also rotate based off of what is hot. Different sectors perform at different times. Layer 1, they have infrastructure, DeFi, gaming, AI agents, AI-powered protocols, and meme coins, which are based off of speculation and narratives. And right now, layer 1s are performing well. Meme coins are doing well. AI had a run, but it cooled off. And your job is to identify which sector is gaining momentum and rotate that capital accordingly. So my exit strategy is I sell altcoins when they stop outperforming Bitcoin, when the narrative weakens, like the dev leaving, the competitor launches, or macro shifts, or I just hit my price target, or if just the market sentiment reaches euphoria. I don't wait for them to go back to zero. I don't hold them forever. I'm cheating them. I take profits, I rotate, and I move on to the next opportunity. Altcoins can accelerate wealth creation, but only if you approach them systematically. Don't over diversify, don't marry your bags, and rotate based off of your performance. Use altcoins to accumulate more Bitcoin. That's my simple framework for you guys. Taking profits is a skill, and most people suck at it. I just want to explain. I've seen this pattern over 1,000 times. Someone buys an altcoin or a meme coin at 10K market cap. It runs to 100K. They're up 10x. Their portfolio hits 10K, and they screenshot it. They send it to their friends. They feel like a genius, but they don't sell. Why? Because they think it's gonna go higher. It runs to 200K market cap. They're up 20x now. 20K portfolio, but they still don't sell. They think it's gonna go to 1 million market cap. And then it crashes down to 50K market cap, and their portfolio is now cooked. They gave back 75% of their gains. That's called a round trip, and that's how most people lose in crypto. Greed, attachment, lack of a plan. They don't have a predefined exit criteria, so they just hold and hope. But hoping and coping is not a strategy. Taking profits is like training at the gym. If you never lifted weights, you can't walk in and deadlift 200 kg in day one. You need to build that strength progressively. It's the same thing with profit taking. If you think that you're going to perfectly time the top of a bull market without ever practicing taking profits, you are delusional. You won't do it, and emotion will override logic every single time. So I sell in tranches. When a position appreciates significantly, I take maybe 33% at first target. I de-risk my initial capital, and now I'm playing with house money. Another 1/3 at the second target. Lock in the profits. That's going to be the real money. And then I just keep the rest for like a moon bag. I let it ride for asymmetric upside. That way, I'm systematically de-risking. I'm not trying to predict the exact top, and I don't use rigid price targets for altcoins because altcoins are just narrative driven. You can't predict where they're going to top. And instead, I just track the sentiment. When every single person around me is euphoric, when random people are asking me about crypto, I will sell. When the fear and greed index hits extreme greed, I will scale out. And when Twitter is full of "we're so early" posts and Lamborghini memes, I will take profit. What I look for is Bitcoin price approaching major psychological levels like 100K, 150K, etc. I will look for retail FOMO increasing, like Google Trends spiking, normies talking about crypto, Altcoin pumping on no news, pure speculation, no fundamentals, or just influencers talking about generational wealth content. That's usually going to be the top. Your portfolio feeling too good to be true, if it feels euphoric, you need to sell. These are all signs that we're approaching a local or cycle top. Most people do that backwards. They hold through those bull markets, they panic sell during those crashes, and that's how you lose. You should be selling into strength. And I know when everyone's buying, that's when it feels wrong to sell, but that's when you take profits. Nobody goes broke taking profits. Unrealized gains aren't real. I remember my mom talking about crypto as fake money, and they're just pixels on a screen. Until you convert them to stablecoins or fiat, they don't exist. So what I do is when I take profits from an altcoin or a meme coin, I will move them into stablecoins first, and not into Bitcoin immediately, because I want dry powder ready for the next opportunity. And then depending on the market conditions, if Bitcoin is consolidating or dipping, I will rotate into Bitcoin. And if we're in a clear bear market, I will hold stables and wait. If there's another strong narrative forming, I will rotate into the next high conviction play. Taking profits is uncomfortable, it feels wrong. You will always wonder, what if I held longer? But that's the cost of staying rational. Wealth is what you keep, not what you screenshot or post. So practice taking profits now while the stakes are lower, so when your portfolio actually hits those life-changing numbers, you'll be actually able to execute. Next is patience. The more patience you have, the more profit you'll make, but most traders don't understand that. And if you're impatient, you will overtrade. And overtrading is death by 1,000 cuts. You think you're being productive and you think you're actively managing your portfolio, but really you're just bleeding capital on fees, slippage, and low quality trades. I spend 99% of my time not trading. There are 365 days in a year, and I might make 10 to 15 super meaningful portfolio changes. That's it. I'm not buying and selling every single day. I'm just checking the charts every single hour or watching the trenches. I'm waiting for the moments where I have a clear edge, where the setup is obvious. I only take A+ setups. I want a setup where there's clear market structure, a strong narrative backing the trade, or technical confirmation on multiple time frames. I really want a good risk to reward ratio. I need high conviction based off of all that research, and if boxes aren't checked, I won't trade, I will wait. And sometimes taking no trade is better than taking a trade. And how I structure my capital, as I talked about before, actually enforces patience. So for example, most of my money will be in long-term hold, 20% will be in tactical positions, and 5% might be in those super speculative positions. Every single bucket has their own rules, and that prevents me from doing something stupid with my own capital that's still supposed to sit still. So every single time I'm in a position, I ask myself, if I wasn't in this trade, would I still enter it right now at this price? If the answer is no, I exit, no hesitation. And that prevents me from holding or losing positions out of hope or attachment. Your edge isn't trading more, your edge is just trading better. One perfect trade beats 10 mediocre trades, and that's the art of trading crypto. Be patient, wait for those A+ setups, and execute with actual high conviction. So if you're on crypto Twitter, YouTube, Instagram, it's 90% noise. You'll see fake traders, paid promotions, pump and dumps disguised as alpha. You'll get invited to all these stupid Telegram channels, and if you don't learn how to filter this out, you will lose money. That's a guarantee. So how you would spot them is, if someone claims a 100% win rate, they're lying, period. Even the best traders are wrong 40 to 50% of the time. They never show losses, they only post wins, never drawdowns, never mistakes. That's not transparency, that's just marketing. They're always bullish when the market is clearly in a downtrend, and real traders adapt, and fake influencers just chill. They're gonna constantly promote these new coins. Every week there's gonna be a new gem, and they ghost it after it dumps. If they're always shilling something, they're getting paid to shill, or they're behind the coin itself. So how it works is the influencer accumulates 20 to 30%, maybe even 50% of a low cap coin. They post about it to their followers buy, they're pushing the price up, and then the influencer sells into that buying pressure. The coin dumps, and the followers are left holding bags. That happens every single day in crypto, so don't trust anyone. Verify everything, and if someone gives you a call, do your own research. Don't ape blindly. Look for transparency. Do they show their losses? Do they have a good track record? Do they teach, or do they just give calls? And if all they do is just drop contract addresses and say this is the next 100x, run. Because years ago, I followed Twitter calls, I joined Telegrams, and I lost money every single time. The only consistent profits I've made came from building my own research process and analytical framework. The real alpha is going to be developing your independent judgment. Crypto is full of scammers, and you might know that. Your job is to filter them out, build your own edge, do your own research, and trust your own process. Every single crypto millionaire I know has one thing in common. They didn't build wealth in isolation. Think of crypto as a competitive game. There are different strategies, different approaches. You can either master one strategy yourself through thousands of hours of trial and error, or you can join a group of people who are already winning and learn from them. Option 2 is just undoubtedly faster by far. When you're trading solo, you're limited to your own research capacity. You'll miss opportunities because you're not watching 24/7. You have no one to check your biases. You have no accountability. And when you're in a coordinated group, someone is always watching the market. You'll share your research and insights to catch mistakes before they cost you money, and you have accountability to stick with your plan. The uncomfortable truth is crypto is an insider and information-driven game. The people making consistent money aren't just good at trading. They have information advantages. They might know devs, they might be in private groups where opportunities get shared early or they're finding it early, and they have access to deals retail never sees. They'll coordinate on plays. And if you're not networked, you're at a disadvantage. So that's why I built Fortune. It's not a pump group, it's not a signal service. It's a curated room of 7 and 8 figure traders who share real insights, hold each other accountable, and won't let each other fail. We've collectively generated over 9 figures in profit over the past year. Members like Bayside, who's a 15-year-old kid, went from $300 to managing over a 7-figure portfolio. Eli went from homeless to $40K a month, and Jackson hit 7 figures. Bowen hit his first 6-figure trade on a call that we've collectively made over $1 million on. And if you're serious about accelerating your trajectory, the link is in the description. But whether you join Fortune or not, the principle remains. I want you guys to find your network, build your relationships, and coordinate with people who are better than you. That's how you actually scale faster. Most people enter crypto thinking that they're going to turn 1K into $1 million in 6 months. That's not an actual plan, that's fantasy. So yes, it's possible, but it's not actually statistically likely. The people who actually build wealth in crypto, they think in years, not months, and they're not trying to hit 1000x on one trade. They're compounding 2x, 3x, 5x wins consistently. And if your portfolio went up 50% in USD, but Bitcoin went up 100%, you underperformed. You took more risk for less reward. You should have just held Bitcoin. Always benchmark against Bitcoin. That's the baseline. Most traders obsess over making money. Winners obsess over not losing money. That's the difference. And if you can actually avoid the catastrophic losses, you will outperform 90% of traders, because the most profitable strategy is usually the most boring. Buy Bitcoin, hold, don't touch it, and that beats 90% of active traders. But most people can't do it because it's not exciting. A lot of people think that I'm going to be beating the market, I'm smarter than the institutions. The reality is, no, you're not. You're not competing with Goldman Sachs or BlackRock. You're not moving billions of dollars. You're just a solo person, a solo trader trying to build personal wealth. So the edge is actually agility, not just size trading. You can get in and out of positions faster than a fund. You can take asymmetric bets that they can't. That's your advantage. Trading those altcoins, trading those meme coins, getting in and out fast. Use it. Every single person online claims that they have the best strategy. They don't. What worked for me might not work for you 100% of the time. We have trades who trade completely differently, support and resistance, trend line, supply and demand. They make money, we make money. It's different approaches, but it's the same result. You guys can use my strategy that works, but you also want to find what makes sense to you logically. You want to master it and ignore the rest. Most people try to time perfect entries and exits. They wait for Bitcoin to dip to 50K and it never does. They miss the entire run. Winners just accumulate constantly. And the dollar cost average, you don't try to time it perfectly. And over a long enough time frame, time in the market beats timing the market. So if you want to know exactly what to do right now, I would just say step 1, buy Bitcoin, open an account on a reputable exchange like Coinbase, Kraken, Binance, buy maybe $100, $500, $1,000 of Bitcoin, and start building that foundation. Move it to a hardware wallet like a Ledger or a Trezor if you're holding long term. And step 2, learn market cycles. You want to study the 4-year Bitcoin cycle, understand where we are right now, and read about previous bull and bear markets. Next, you want to master risk management. Never trade more than 1 to 2% per trade. Set stop losses, define your exits. Step 4, start journaling. Track every single decision. Write down your thesis. Review weekly. Step 5 would be building your network, joining communities, follow real traders, not just people that are marketing. Learn from people ahead of you. And if you're already in crypto but not profitable, simplify your strategy. If you're trading 10 different things, you're overcomplicating things. So pick one thing and master it. Then you want to fix your position sizing. And when you're trading, you need to stop prevent trading. Like if you just took a loss, you want to step away. You don't want to trade emotionally. And then overall, just increase your Bitcoin allocation. If you're less than 50% Bitcoin, you're taking too much altcoin risk, and then you just want to rebalance. If you're already profitable, you want to protect your capital. You want to move your profits into a cold storage regularly. You don't want to keep everything in active trading wallets, because my roommate Alex literally got drained for $1 million. You want to build systems. You want to document your process, create checklists, and remove emotion from execution. Networking is so important. Just finding people who are ahead of you. You want to learn from them and collaborate. And when you think long-term and not just optimize for one cycle, you actually build wealth that compounds over decades. So there you have it. You have 7 years of knowledge condensed into one video. But knowledge without action is just going to be worthless again. So take one thing from this video, just one, and implement it this week. Whether it's going to be starting a journal, buying your first Bitcoin, or fixing your risk management, just do one thing, because one action will compound into more actions. And that's how you build momentum. And if you're serious about this and trading crypto, apply to Fortune. That's going to be the link in the description. And if you can't join yet, just subscribe. I drop insights every single week. And follow me on Twitter for real-time analysis and just crypto Twitter tweets. Just remember, guys, patience will compound. So just start building now.